Welcome back to Algobot, the channel where we open up automated trading strategies and study exactly how they think. I'm your host at Algobot, and today we're examining an expert advisor for MetaTrader 5 called Fair Value Gap Stride. This is a pure price action strategy, with no indicators at all, built around a footprint that serious traders watch closely, the fair value gap. By the end of this video, you'll understand what a fair value gap actually is, why a stack of them signals genuine momentum, and how this momentum continuation strategy rides that strength instead of waiting for a pullback. Let's get into it. So what does this expert advisor actually do? Fair value gap stride is a momentum continuation strategy that reads nothing but raw candle geometry. There are no moving averages, no oscillators, no smoothing filters of any kind. Everything it decides comes straight from the open, high, low, and close of recent candles. The central idea is the fair value gap, sometimes called an imbalance. A fair value gap is a three-candle pattern. When a strong middle candle moves so fast that the first candle and the third candle don't overlap, it leaves behind a small band of price that was never properly traded. Think of it as a vacuum left in the market by an aggressive push. Now, a single gap on its own is just noise. It happens all the time. What this strategy looks for is a stack of them. When price prints two or more same-direction gaps inside a short window, and none of those gaps has been filled back in, the market is, in the developer's words, striding. It's leaving a ladder of imbalances behind it. And that is the signature of a strong displacement leg, the kind of move that tends to extend further before it rebalances. Here's what makes this strategy different from most fair value gap systems you'll see. The common approach waits for price to dip back into a gap and tap it before entering. This one does the exact opposite. It enters at market, immediately, in the direction of the stride, while the imbalances are still wide open. It's betting on continuation, not on a retracement. The strategy is designed for liquid markets like the British pound versus the US dollar or gold on the 5-minute and 15-minute time frames, though it can run on any liquid symbol and time frame. It suits a trader who is comfortable with momentum breakout trading and wants a rules-based, fully mechanical way to participate in strong directional moves. Remember, this is for educational purposes only, and nothing here is financial advice. Let's walk through the logic step by step. Everything begins on the close of each new bar. The strategy only acts once per freshly closed candle, and only when there is no position already open for its magic number, so it never stacks trades on top of itself. First, the strategy measures volatility. It adds up the high-to-low range of the most recent candles, by default 20 of them, and divides to get an average candle range. This average becomes the yardstick for everything that follows, so the strategy automatically adapts to quiet or busy markets. From that average, it derives three thresholds. The minimum impulse body is the average range multiplied by the impulse factor, by default 1 times the average. The minimum gap size is the average range times the gap factor, by default 15%. And the stop buffer is the average range times the buffer fraction, by default 20%. Now the strategy hunts for a fair value gap on the just closed bar. For a bullish gap, it checks 3 candles: the newest, the middle, and the oldest. The high of the oldest candle must sit below the low of the newest candle, leaving a true up vacuum. The middle candle must be bullish, and its body must be at least the minimum impulse size, proving a real thrust. And the gap itself must be wider than the minimum gap size. If that trigger gap exists, the strategy scans backward across the stack window, by default 6 bars, counting every bullish gap that is both valid and still intact. A gap is intact only if no candle has since closed back below its base, meaning the imbalance has not been filled. It also tracks the lowest base of all those gaps. When the number of intact stacked gaps reaches the stack count, by default 2, the EA signals a long entry at the current ask price. The stop loss is placed below the lowest gap base, minus the buffer, sitting under the entire imbalance ladder. The risk is the distance from entry to stop, and the take profit is set that distance multiplied by the reward to risk value, by default 1.5, above the entry. The bearish case is the exact mirror, stacked down vacuums from bearish thrusts, a sell at the bid, and a stop placed above the highest gap base. Let's read the actual MetaTrader code on screen. At the top, we have the input parameters, the dials you can turn in the strategy tester. Lots sets the order volume. ImpulseFactor controls how strong the middle candle's body must be relative to the average range, so raising it demands more violent thrusts. MinGapFactor sets how wide the vacuum must be before it counts. StackCount is the heart of it, the number of unfilled gaps required to call this a stride. Raising it makes signals rarer but more selective. StackWindow is how many bars back the EA looks for that stack. RiskReward sets how far the target sits relative to the stop. BufferFrac pads the stop beyond the ladder, and look-back range is how many candles feed the average range calculation. Now the signal logic. The strategy first calls try bull gap on shift 1, the just closed bar, to confirm a fresh gap exists there. If it does, it loops from 1 to the stack window, and for each position it asks 2 questions. Is there a valid bullish gap here? And is that gap still intact, meaning unfilled? Every gap that passes increments the count, and the code keeps tracking the lowest base across all of them. Then comes the trigger. If the count reaches the stack count, the EA reads the ask price as the entry. It places the stop at that lowest base minus the buffer, computes the risk as entry minus stop, and sets the take profit at the reward to risk multiple of that risk above entry. Finally, trade.buy sends the market order. The short side is the precise mirror of everything you see here. Let's bring this to life on the chart. Notice there's no oscillator panel here, because this strategy reads nothing but the candles themselves, and the shaded boxes you see are the fair value gaps, the untraded vacuums left behind by fast moves. Watch the left side first. Price pushes higher, and a strong bullish candle carves out the first green box, our first bullish gap. The market keeps driving, and a second strong candle leaves another green box stacked just above the first. At that moment, 2 same direction gaps, both still unfilled, the stride is confirmed. The strategy enters long at market on the buy marker, riding into the strength rather than waiting for a dip. The protective stop would sit just below the lowest green box. Price continues climbing, candle after candle, until it reaches the take profit marker at the fixed reward to risk target. The long trade is complete. Now watch the right side, where everything mirrors. Price tops out and rolls over. A strong bearish candle leaves the first red box, a down vacuum. Momentum continues, and a second bearish candle stacks another red box just below it. Again, 2 unfilled gaps in the same direction, and the bearish stride is confirmed. The strategy enters short at market on the sell marker, with its stop placed just above the highest red box, above the entire ladder. Price then slides lower through several candles until it reaches the take profit marker below. The short trade is complete. So in both directions the pattern is identical. Spot a stack of fresh, unfilled gaps, enter into the momentum, anchor the stop beyond the whole ladder, and aim for a fixed multiple of the risk. This is an illustration of the logic only, for educational purposes. And that's fair value gap stride. We covered what a fair value gap is, why a stack of unfilled gaps signals a strong displacement leg, and how this expert advisor enters into that momentum at market rather than waiting for a pullback. We saw how it scales every threshold to the average candle range, anchors its stop beneath the whole imbalance ladder, and targets a fixed reward to risk multiple. Remember, this video is educational content only, and it is not financial advice. Always test any strategy thoroughly on your own before risking real capital. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and drop a comment telling me which strategy you'd like me to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.